This episode of the Old Dogs REI Network is brought to you by Mino Studio.
In a world where jobs are how most people make money, one man, one desire, one challenge dares to break the mold. Welcome to the Old Dogs REI Network, where we don't work for money. Money works for us. Coming soon. Viewer discretion advised.
Welcome to the Old Dogs REI Network, where cash flow is king. Real estate investing, the means, so you can enjoy your retirement dreams. This is the show where we cut right to the chase. No sales pitch, no long monologues, just simple how-to real estate investing advice, so you can earn the passive income you need to enjoy your retirement today. And now, your host and chief old dog, Bill Manacero.
Welcome to the Old Dogs REI Network. I'm your host, Bill Manacero, and this is the show where 50-plussers and anyone else who wants to join us get solid, no sales pitch real estate investing advice to help generate real cash flow. The podcast airs twice weekly on Mondays and Fridays, and if you aren't already a subscriber, go to iTunes, type in Old Dog, spelled D-A-W-G, find our podcast, and subscribe. Well, we've got a fun show ahead for you here. We have no stranger to the Old Dogs REI Network podcast that is going to be joining us again today. His name is Buck Joffrey, and Buck has been on two previous episodes. The first one was part-time real estate investing. That's right. That was January 30th, 2017, and that was episode 071, and then followed by 151, where we talked more strategic passive investing, talking about syndications and so forth, and how Buck invests in those things. Buck, as you will remember, if you've listened to those shows, he's an accomplished physician, entrepreneur, asset manager, and podcaster. And he has a great show called Wealth Formula Podcast, where he talks about not just real estate investing, although he is a big believer in real estate investing. He covers a lot of types of investments. And I think it kind of started out as a show where he was talking to a lot of his cohorts in the medical profession and sharing, how do we invest? How do we make good decisions? And, he talks about how the old mantra of investing in a diversified portfolio of stocks, bonds, and mutual funds is outdated and actually dangerous for a lot of people that are investing in those types of things in today's global economy. So anyway, I just want to welcome back an old friend of the podcast and mine as well, Buck Joffrey. Buck, welcome back to the Old Dogs REI Network.
Thanks for having me back, man.
We got to get you a mug or something, with the old dog on it or something. I mean, this is you're like part of the family here. This is great. Your shows are well received by our audience out there because you really do have a great concept of investments and how to really maximize your personal investment portfolios, as well as many people that listen to your shows and follow your advice as well. So I just wanted to just kind of get updated here and find out what you've been up to since the last time we've talked.
Yeah, I mean, well, first of all, I don't think I've talked to you since I moved back to Santa Barbara.
No, that's right.
Oh, yeah, we're not far away from one another. It was about a year ago I moved to Santa Barbara from Chicago, and completely permanently called it quits from any kind of practicing medicine. So, trained until I was 34, practiced until a little. I practiced for the most part for about 5 or 6 years, and then really slowed down, but really called it quits completely last year at 43. And I'm just loving it. I'm just totally, completely immersed in investing and putting together opportunities and podcasting and educating and all this, and it's been cool.
I think this is an area that's really applicable to our audience too, because they're folks that are either retired already or approaching retirement, and their nest egg and the funds that they're generating are something they've worked hard for, and so they're very, very conservative investors. I'd say most of them that I've spoken with, and they don't just want to put it all on red, so to speak, and spin the dime. They really want to be able to know that where they're putting their funds is going to be the most solid investment and so forth. So, so I'd like to hear kind of, one of the things that we had talked about off the air here is that, we're encountering a lot of different things on the real estate front here in terms of finding the good properties, and it has become a different environment, a different market out there right now for finding those great real estate deals that a couple of years ago were just everywhere. And so as someone here that's looking for those deals, it has been a major preoccupation on my side, just direct mail, going direct to seller, going beyond just our broker contacts to find good deals. And but there are also there's that overriding concern that we know that the market's going to correct itself somewhere. I mean, that's just historically what has happened over many, many decades. And so there is that caution at the same time and that's one of the reasons why we haven't just bought anything, because if I can't buy it under market, if I can't buy something that can survive a market correction, then I'm going to regret it. And so we try to buy things under market. We try to buy things that our rents can be flexible, and even if we increase them, that we can decrease them and still not cut too much into your bottom line. And you're a professional investor, and you're not just looking at real estate, but you're looking at many different avenues. And I'd really love to get your insight about this approaching period and how you're looking at investments here.
Yeah, I mean, I think you're right. I think few would argue that we're not in the ninth inning, or potentially even just sort of sliding back down again already, because I can tell you that what I'm doing. Here's what I'm doing. The properties that I owned individually, I'm actually selling. In fact, I'm closing on one of them right now. And to your point about great deals happening 3 years ago, 4 years ago, easily. I mean, I bought a couple buildings up. One of them I'm closing today, and the return in 3 years will be an annualized return of over 100%. Gosh,
that's great.
Right. I mean, so the numbers are staggering when you look at that way, right? Now, so it's a good time to sell. For that's yes. One thing. It's a good time to sell. In terms of buying, which I'm also doing, I am, I'm working, with some particular groups on in aggregating funds similar to what you're doing, and we have had success. We've now done about 3 multifamily deals this year, and the challenge is what you're saying is absolutely right. We're in the ninth inning, so the question is, what is it that you need to do? Identify the dangers, and then then identify the goals, and then figure out what you're doing. So what are the dangers of a downturn? The dangers of a downturn really, for the most part, are losing the property, right? I mean, that's really what the danger is. That you're all of a sudden, you have some sort of a capital call from the bank, and that you got to either put in money or you're going to lose the property. That's the real danger. And that's actually not what a lot of people think about, right? They think that the real danger is that you're going to be upside down on your rents. Well, if you can still buy something right now, even if you're buying something, say it's a cap rate of 5.5 or something like that, right? With leverage, you can still be, unless you really screw it up, you can still keep positive cash flow after leverage. The real challenge is something that I think not enough syndicators are paying attention to, and I think what's going to bite them in the butt is that appraisal values are going to go down because of cap rate decompression. And when those appraisal values go down, people are going to be over leveraged, and then the bank is going to do capital calls. You know what I mean by that?
Yeah.
This is critically important, and very few people talk about this. Now, I know of groups out there, where you've got, a bunch of people part-time, who are really taking down significant buildings. They're taking $20, $25 million buildings. They don't have professional asset management, et cetera. And they're doing 80% loan to value, meaning maximal leverage with Freddie Fannie debt, right? And what is now, if they did, and they may be cash flowing, but here's what the issue is. If they do nothing and they just keep cash flowing, there's a pretty good chance they're going to lose the property, right? Because you have a loan covenant of 80% loan to value. If you're not doing something to increase rents, to decrease your leverage, and if you have an appraisal that happens automatically, as does with non-recourse debt, with Fannie Mae debt, every 18 months, guess what? Regardless if your property is performing or not, the bank's going to call and say, hey, we only promised you 80% debt, and we just appraised the property, and I know it's still performing fine, but you know what? It's not worth as much anymore, and now you've got 90% debt, so we want another 10% of capital, or you're losing the building. That's what happened in 2008. I remember Robert Kiyosaki telling me the story, exactly that story that happened to him. Of course, he had the money to cover it, but he was cash flowing thousands of dollars on a property that he owned, and he got a call from a bank, and he's like, what are you talking about? I'm making like, $30,000 a month on this building. And they said, well, yeah, that may be the case, but our loan covenant only promised you so much leverage.
Yeah, and I think that's been one of the issues that I think a lot of investors are dealing with. There, I would say, maybe 3-4 years ago, many people are looking at even the short-term type financing, where they're looking at a 3 to 5 year exit plan, and in that they take on maybe a less desirable loan, or maybe interest only, or a lot of different approaches to what they could do, but they're looking at things going up and things getting better. But if things turn around and you're in that kind of a precarious position, I've known many investors right now that are looking at strictly long-term plays. In fact, they're telling their investors, that we may not cash out in 7 years, 3, 5, 7 years, and that it may be a long-term hold. And in that, there might be, especially if they can buy under market, then there might be a way of being able to survive that correction.
I think buying under market is really very, very difficult right now. I think it's actually impossible. I mean, if you're a seller, why would you sell something less than market at this point? As you know, right now, when you have a decent asset and it's like a 100, 200, 300 unit building, it's a seller's market still, right? You've got people who are bidding, and hard money goes day one. I mean, it's insane. So to find something that's under market is it's very difficult. So to me, like, what it really comes down to, and listen, I like to look at things and say, okay, how can I take this thing apart and understand what the danger is? If the danger is losing the property, so goal number one is obviously capital preservation. You're not gonna do something where you're gonna feel like you can lose it. So how can you make sure, or how can you mitigate that risk? Well, there's really only one answer to it. The answer is to figure out how you deleverage, right? And what I mean by that is not just, okay, take a loan with less loan to value, which might be part of the solution. You might be doing, if you get a 80% LTV loan, maybe only take 70% of it, give yourself 10% cushion. That's one thing you could do. Another thing you can do is say, I'm going in here, but my intention from day one is to drive a ton of equity into this property, right? This is not a market, in my opinion, where you can buy and hold and look like a genius like you could in the last decade. This is a market where you have to go in and you have to drive up net operating income. And in the process of that, because you're driving up net operating income, you are deleveraging, right? So those are the two major things that I think you can do. I think you can take a little bit less leverage, and then you can drive net operating income, and that's what the things that we're doing are really focused on. Now, one other thing, there isn't a lot of groups that can do this, and this one of the groups that I'm working with, there is a Fannie Freddie loan that literally offers you, and only about 5 groups in the country get this, but have got this opportunity, but you can get 100% LTV covenant. You don't take it all, but you can get 100% LTV covenant, and maybe you take 72, 73%. And that's what we've been doing. And that's, to me, feels incredibly comfortable, because I'm like, well, I know we're not going to leverage that much, and we're driving massive amounts of value in these properties. So to me, that's where I feel comfortable. I think that deleveraging is the key.
That's great. Now as you're looking at potential investments, syndication or otherwise, what kind of factors are you looking at? I know maybe your criteria has probably changed, where you might be a little bit more open to a higher degree of risk in the past when things were going great. What kind of criteria have you set in terms of those types of opportunities?
Yeah, I mean, for me right now, I'm only really working with one group, and it's because they're one of the few who have this kind of debt that I just mentioned. And from a criteria standpoint, what that means is we're really looking at properties that we can drive a lot of equity into. So you may not find under market properties, but you certainly can, in just about any market, find underperforming properties, right? So an example, a deal, we're closing on this week, Mesa, Arizona, for example. I mean, this is I think 150 units, and it's really one of these properties that has been owned by, for the most part, sort of mom and pop types, whose primary focus has been, just maintaining 100% occupancy, and they really haven't updated anything since probably 1985. And so that kind of opportunity, if you can bring in, if the goal there is just, it's in a great area, it's in an area with a lot of California flight, by the way, a lot of people leaving us. Mm-hmm. And it in that situation, it just sets up an opportunity where from day one, okay, bam, 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 if I can do this, I can just see the comps here. I've already almost, doubled my equity in this property. Those are the kinds of things that we're looking for. Now, the reality is it's very difficult to be the ones to get those deals, because I think, like I said, the group I'm working with is the second biggest owner in Phoenix, so it makes it a little bit easier for us to get properties in Arizona, right? So it's like, but it's hard, I think, if you're, a smaller fish to get those opportunities from, a buyer standpoint, right? Like it's tough. It's a tough market. So criteria-wise, the only thing that personally I'm looking at is things that you can do massive value add plays. And I would stick personally, in my opinion, and I don't know how you feel about this, but right now, to me, staying in primary markets is wise. Because when I say primary, I'm not talking about New York City. Of course, that's silly to invest in New York City. But, I still think, even though the numbers are tight, stick to places like Dallas or San Antonio or Phoenix or Atlanta, places like that. Because guess what? Population is still driving up there. There's a lot of economic activity still happening there. And in the long run, you're going to be just fine. I'm not a huge fan of the Oklahoma City markets and things like that at all, that are so oil dependent and monolithic in terms of, their dependence on one kind of, wealth generating activity.
You really hit on it too. I think finding a 150 unit mom and pop owned property is key, but hard. I mean, because especially when you get over 100 units, it's more likely that they're going to be owned by corporations, institutional investors, even foreign investors, and it's much more difficult to sort of negotiate those great deals or find underperforming that are owned by more sophisticated entities. We're even looking at lowering our unit threshold here if we can find it, in that sweet market where you can still have on-site management, but you can still maybe get a little bit under the radar and still find that mom and pop property, which is a little bit of challenge as you get into 200-300 units.
Yeah, absolutely. I mean, I think it's a tricky thing. I think with from a syndicator standpoint, and I've been on both sides, right? I mean, I syndicate and I'm also passive. From a syndicator standpoint, it's challenging because the properties that you want to that make a lot of sense sometimes are the larger properties. But listen, there's not a lot of I think there's a lot less. I think there's a lot less of this kind of crazy overbidding when you get down into that, sub 5 million, maybe even sub 7 million type assets. I mean, I think there's, and in those cases, you only have to bring a couple $1 million of equity to the table. But even that's getting crowded, as you know, because you're not, you and I aren't the only ones who are thinking that.
Right. And that's the issue here, especially as we're talking about the ninth inning stretch here, is that people are skeptical of most of the traditional types of investments. And I think looking at the market as a whole, especially the stocks and bonds and so forth, that people are getting even more skeptical because they've seen these dips. There's that concern that, wow, am I going to be able to get that return? Am I going to lose a lot in that kind of an environment? Whereas real estate, you still have the asset, but you hit kind of the elephant in the room that nobody wants to talk about, and that is, but what if you lose the assets?
Well, yeah. And I hate to say it, but particularly knowing what's going on in certain markets like Dallas, where there is a lot of, even now people are just paying really stupid prices. I'm not talking about institutions who can handle this and absorb this. I'm talking about people who are just getting in the game now, way overbuying, way overpaying. Cap rates of, just 5 for C- class properties. And they're doing it and they can get away with it as long as cap rates stay where they are. But it can't go on in perpetuity. It can't. We know that. We know that for a fact, right?
Yeah, and that's what's killing me. As I'm looking at these properties, and we will analyze and overanalyze these properties. The asking price is ridiculous, and yet there are people coming in and buying at the asking price, and maybe even over the asking price. I'm going, who in the world would do that?
Well, I'll tell you who would do that. There's a couple different types. There's groups like potentially a group that has identified that they can bring capital and very, very quickly, create value where there's, currently not value. But those are real professional operators, right? Mm-hmm. A lot of others, okay, and then the other groups that are, some of them are doing it, is foreign capital, and foreign capital sometimes is just coming in and paying cash. You might ask, why would they do that? Well, I had this conversation with an investor, a person in my investor group yesterday, and he said, "What do you think of gold?" And I said, "Well, yeah, gold is okay, but what's the point of gold? Gold is the anti-dollar, right? Gold is hedging inflation. So if you don't want, but what's the problem with gold? Well, never really creates any cash flow of any kind, right? So put those together, And so why wouldn't you just buy, if you've got hundreds of millions of dollars to deploy, why don't you just buy a $25 million building for cash? And even if it's, a 5 cap or whatever, maybe it throws off a little bit of cash. What are you doing? You're just buying gold, right? I mean, it's basically the same thing, because with inflation, that property will go up in value over time. It may go through some down in the short term, but in the long run, you don't have to worry about debt because you've paid cash. And you know that it is, it's going to go up in value with inflation. So that's the other group that buys those properties. And then there's the third group who's just going, those people we're going to be very happy about, when things turn. It's bad for them, but it's good for us, Bill, because that's where properties are going to come out and probably become available for people who are being patient because they don't know what they're doing. They're buying for too expensive. They're just hoping to get rich.
Yeah, and I think that, I don't know if you'd say there's a fourth group here, but there's also the 1031 buyer, and these are folks that before they could make that transaction within that window of time, but now they're panicking and they're paying over, or they're just trying to again go for the tax savings by staying in the 1031 exchange, and at the same time, they're driving property values up too, because they're just trying to plant their money somewhere.
Yeah, I think there's some truth to that. I mean, I think for me personally, like I've kind of, like I'm selling this property today, and it didn't even cross my mind to even bother 1031ing, because I'm like, what am I going to buy in this market? I'm just, I have other ways of mitigating my tax issues. I talk a lot about them on my show, but I didn't want to sit there and like get into something and overpay. Overpaying right now, knowing you're overpaying, it's kind of crazy, right? So.
Yeah, folks have the cash. I get it. If they can buy it at a reasonable price, because you can write it out, and everybody has, and things do come back up. And but like you said, it's kind of like buying gold too. There's a weight that's involved here. I mean, you could still cash flow it, and it'll produce for you, but just knowing that you may have to wait 5-10 years or so before you're going to see any kind of rebound.
Right.
Your portfolio, if I can get personal with you here a little bit, what would you say if you could lump it into, let's look at a pie here, how are you diversifying in your investment portfolio, percentage wise in certain categories?
Well, I'm still heavy in real estate. At this point, I'm probably 80% syndications is a passive, 20% of real estate that I own myself at this point, and that part will go to zero soon. When I'm a passive, I'm also a lot of times on the GP side. I'm also on the general partner side, so I actually am kind of owner and investor in that situation. I would say that probably real estate activities, and in between multifamily, self-storage, medical, and what else? Just various stuff like that. I'd say probably it still makes up about 75%. That's really my comfort zone. And then then I have some interest in some things that are a little bit different than others. I mean, there are some insurance products that I'm really I just think are really great opportunities, that are great hedges. So that may sound crazy, but you can learn about it at wealthformulabanking.com. But it's pretty miraculous that some of those things exist out there. So I'd say probably makes about another 10 to 15%. And then you've got about 10-15% left, and that I am at that point pretty speculative. And this is something that I've kind of talked about lately, because I think people think of speculation sometimes as a four-letter word, and you sure it can if you don't have any money, right? I mean, it's a bad idea to speculate with money that you need. But I kind of put this basket, another basket out there, which I kind of have decided I call it my Maserati money or my Ferrari money, right? I've done reasonably well over time, and I always have this moment where I'm like, you know what, I really like, really like Ferraris. I want to get a Ferrari. My wife hates Ferraris, so that's one of the reasons I won't get one. Thanks to flashy, but or a Maserati. I like Maseratis too, but I don't buy them. And every time, what I think about is, okay, why don't I do this? I'm going to say, instead of spending $100,000 or $200,000, why don't I take that money and speculate? Because for me, that's almost more fun, because I'm kind of built that way, right? I love the game. So I have probably 10%, maybe 15 even, in what most people would consider highly speculative investments. Now, I don't think of them as, I prefer to call them asymmetric risk plays. And I think the idea for me is that if I lose the money, that it won't kill me. I mean, literally, I could just buy one of these, I could buy one of these doodads, and I just know it's never going to make me any money. I bought it anyway, right? Mm-hmm. So instead, why don't I, put my money in something that I think is going to explode? And if it does, then I win big. And if it doesn't, well, I lost some money, but I didn't buy the Ferrari either. So that's kind of the last basket.
Well, I want you to elaborate a little bit on that too. But now you've never thought of maybe being like an angel investor and investing in other businesses, or I thought you talked about that at one time, or you had an interest in that.
I have an interest in it. I just, I've been a startup guy my whole life in terms of business, right? So I've never really. So I think, I think people who buy businesses and who invest in businesses, I think they have a different skill set than I do. I don't have that right now. If I had it, I would love to do it. But I think for me, you kind of have to stick with what you know and what you're good at. And, for me, I know how to start up a business, right? I've done it several times now. I've started up multiple businesses. And from the standpoint of understanding what it takes to do that, I'm not intimidated. But trying to buy a business somebody else owns or invest in something that somebody else is posing privately, I am totally open to it. I don't really have the guts, because I don't really like doing things that I don't understand. Even the speculative things that I do, I feel like I understand, right?
Right. Yeah, and it's tough. You're also investing in people when you're investing in those types of ventures, and you don't always know everything as much as you can do your due diligence on that person's background and experience and skills and qualities, what have you. It's still that this unknown variable that you're investing in, whereas other things that have at least some sort of track record, even the stock market. I mean, you can track it, or you can go more conservative and invest in things that are a little bit more solid and have more solid returns. But that is one of those areas.
I have friends who do it, Bill. I mean, who are really, really good. I mean, they buy businesses and they basically flip businesses, and they make enormous amounts of money doing it. I really wish I had that skill set. I don't have it.
Yeah, it's a certain type of person, right? They're usually on Shark Tank or something like that.
It's like where what you grew up doing. I mean, I think at the end of the day, that's really what it comes down to. Is and it's a lesson for our kids too, right? I mean, listen, how is it that how is it that I feel very comfortable starting a business in the medical space? Well, I'm a physician by training, so I understand that world, right? So most of my friends who do these things that happen to, making a ton of money, they started out working in that industry and then realized, hey, I can do this. I have a guy who was just killing it in town, and he used to work for a company. He's a Canadian guy, where they'd arbitrage electricity to other countries from Canada.
Really?
Right?
Wow.
I mean, now we're talking about some serious bucks there, right?
Mm-hmm.
So he was working for the company, and then he was really, in the weeds in the operations here. And then he and his buddy who were working there, they didn't have any non-competes. They just said, we can do this. And they started their own company. They're making, oh my God, how much money these guys making. I mean, imagine selling electricity to nations, okay?
I can't even fathom that. That's like
right.
being an arms dealer or something.
Right.
Okay.
So, but how did he get it? I mean, was he just, born with some unusual skill or what? No, he just, it's the luck of the draw. You got a job where you figure out, and if you have an entrepreneurial gene and you put that together with understanding the intricacies of a business that can make you a enormous amount of money, ding, 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 you've got the, perfect formula. I mean, I started businesses that involved healthcare and seeing patients and stuff like that, which makes, more money than, most people. But, I mean, I'm not selling electricity to China.
Yeah. No, that's one of those. Well, along those lines, some of maybe the more fringe, maybe that's not the right word, but some of those maybe, what did you call that category that you invest in? The
asymmetric risk?
Yeah, asymmetrical. Yeah. Which of those have you actually seen some good returns on? And just out of curiosity.
For me, I am now fairly deeply entrenched in the world of blockchain technology, and otherwise known as cryptocurrency. Otherwise, and then at least most people at this point have heard of Bitcoin. It's an absolutely fascinating field, and I just what's really fascinating about it to me, Bill, is that not only is the technology, if you get under the hood and you really look at what's going on, this technology is as big as the internet. There's nothing that's going to stop it, not even Jamie Dimon, right? And the last thing is that's really interesting about this is that it is a social movement. So it's a social movement. It is a technology movement, and it's driven by computer scientists and libertarians. And I think it's a force that's to be massively reckoned with. If somebody goes and listens to your show, listens to this show in 5 years, and today is what, we're in like August 20-something, 2018. In 2023, I think the market cap in cryptocurrencies right now is probably right around 200 billion. It'll be well over a trillion. And I wouldn't be surprised if it was 2 or 3 trillion by the time 5 years rolls around. And the reason is that understanding what this technology is critically important. This is not tulips, right? People, especially the bankers, are making this sound like it's a fad, it's BS. There's no question there's bubbles. There's no question, but there was bubbles. At one time, Amazon, Bill, you probably remember this, was up to $100 and dropped down to $1.
Oh, sure.
It said, guess what? Amazon is done. Guess what? Internet was a big, maybe it was rat poison, right? Well, what happened to Amazon? What if you bought it at $1?
No, tell me about it. Yeah, I mean, that was one of my favorite tech stocks.
Right. That's exactly what's going to happen. I am convinced of it. I am convinced of it that this is going to happen with blockchain technology. Why? Because ultimately what blockchain is doing, and it's not just blockchain, this is an entirely different show. And by the way, I am starting another cryptocurrency podcast. So if you want to get interested in this, start listening to that. It's not just blockchain. It's a blockchain. It's more distributed ledger technology, and we can get into that if you like or not. But fundamentally, what it is going to do, it is rebuilding the internet. Okay? Now, we're going from an internet right now that is fraught with hackers and advertisements, et cetera, et cetera, et cetera. What blockchain and other distributed ledger technologies are doing is we're going to create an internet where it is no longer, it's hack-proof, where you can trade with your friends peer-to-peer without a third party, where you can do all things on the internet pretty much not for free. You're gonna be paid to be part of it, but you're not going to pay one entity. It is a movement that's ultimately going to eliminate the need for or significantly reduce the need for financial services industries, and that's why the banks hate it. This is a big deal, and in my view, knowing what I know about this is bigger than the internet.
This is, for me, I'm an old dog here. I think it's easier to understand selling electricity to other countries
Yeah.
than this obscure, this technology that, I just can't. I've read so much stuff on this, and just trying to understand how it's even governed. And then there's that element too, which for me, and again, I'm not criticized by any means. I'm just trying to understand it. But to me, it's kind of a gray area in terms of the internet right now. I mean, it went from pretty free and open to, it looks like there's some regulations and regulating that's kind of going on here. And as it's sort of changed its focus in the last few years, and that part has me a little concerned is, who's going to do the regulating if there's regulating that is going on, and how will that impact those that are doing any kind of commerce on it?
Yeah, I mean, I think the way to look at it too, though, is remember that underlying all of those issues is a world-changing technology, right? So if you can get past all of the noise, because this is so disruptive, what's going on, and that's what's going to make it so big, Bill. I mean, it is challenging the way fundamentally everything is currently done right now. I mean, let's just go through some examples of like what this kind of technology can do right now. So think of anything that currently has a third party that administers it. Okay, what do we do on the internet? Okay, let's say, how about we bank, right? Why do we even, when we transfer money, if I transfer money to you, Bill, somebody has to keep record of that, right? And right now it's the banks, right? Right now it's banks, because you can't, that prevents us from using the same, that prevents me from sending in the same money, saying I have this money and sending it to 5 different people. So the bank has to keep a ledger. It's a central ledger, right? Distributed ledger means you don't have to have that anymore. Now it means that I can send you money and we can eliminate the bank from that transaction, because there will be a permanent record that's immutable of that transaction. Okay, so money's easy. Let's talk about something else. How about Uber? Okay, because people always use Uber as the Uber of this industry, whatever, like Uber transformed and destroyed the taxi industry, right? Mm-hmm. Why would we need Uber if we had a decentralized application that linked buyer or people who needed a ride with people who had cars, right? So now you're getting into situations where every situation where there is a middleman, you can eliminate. Okay, electricity. We were talking about electricity before. My friend does this arbitrage stuff, right? And I was talking to him about the dangers that he has around his business model with this. There is currently programs in Australia that are using this whole technology to sell, to take people who are creating energy through solar energy and selling it directly to people who need the energy without going through a power company, because a power company is just a third party. You see what I mean? It's not just currencies, right? That's the fallacy here. This is a new way of doing things. It's going back centuries and centuries before there was a middleman for every transaction we did. Now it's a peer-to-peer world again. Mm-hmm. And that's the real power of this whole thing. And I know it's a little bit confusing, but I would highly encourage anybody out there who is interested in this at all to really dig deep. And like I said, I'm starting a podcast, probably will be launching in September sometime, and I'm going to start basic and then we'll get more and more complex. But in my opinion, Bill, if you ignore this, you will kick yourself. Mm-hmm. You will kick yourself.
Already, you see this, this whole world of crypto millionaires, billionaires that are, you really don't hear a lot about, but that started when Bitcoin started, and we're mining and doing all that stuff early on. So there's some people that are making money on it. It's just, again, to me it seems so foreign, and I kind of like stuff I can get my hands around and control. That I can buy a piece of property. I know what I can do to improve that property.
Well, listen, we're not talking about your core investments here.
Right. This is that other fringe share.
This is the way I see it, and it may not be appropriate for most of your listeners if you're completely in capital preservation mode. Right. But I'm still I'm still wanting to keep the possibility open that something that I put $100,000 in turns into $10 million.
Right.
And that may sound ludicrous, but guess what? That's happened in cryptocurrency several times, and to the extent that I don't do it blind, because I'm pretty heavily involved with understanding these projects. There's no question you wouldn't want to do this blindly. Now, I will say that probably, almost certainly by the end of 2019, there will be some kind of a publicly traded ETF. Mm-hmm. And it might be worth, if somebody wants to get exposure to this, put some money in there, But yeah, you don't do this with your core stuff. For me, I always like to have, for me, at where I'm at in life, and I think for a lot of people, there's the slow and steady way of getting rich, and that's the proven thing to do. And I that's where 90% of my money is. But if there's a possibility of hitting a home run, why not do it? Why not? Why not get exposure to it? Gotta have some excitement here. Come on.
Sure. Well, already, I think I'm going to take some heart medicine right now just listening to you. But no, I'm just kidding. But I think it's something worth. Definitely like to get educated more on it. So I'll listen to your podcast.
I'll make a believer out of you, because I know you're more techy than you than you pretend to be. I'll run this podcast.
Well, that's just it was big in the tech world early on, and software and the internet. When internet companies started coming in and all that stuff. But I'll tell you, my eyes just kind of glaze over when it maybe just when I got the Bitcoin thing down, then all these other cryptocurrencies came in, and I go, what's that? How do I know what that's doing? Right. And so I'll listen. I'll definitely listen, and to just I want to get more educated on that. That's great stuff.
Absolutely. I think that's the key. And again, it's not for everybody, but for me, I've got two hobbies really. I've got I watched the Minnesota Vikings. I've watched him since I was 5 years old, and now it's cryptocurrency. Those are my two hobbies.
We got to get you out more here. No.
And I've done just fine in my life, and I still drive the Prius that I bought the day after residency in 2008.
Oh, that's great. That's great. Well, Buck, it has been great having you on. I could listen to you and talk with you here on and on. And I love the just your approach. I think it's funny because it's so weird to hear you talk about cryptocurrency because I know how conservative you are when it comes to investing in real estate. You're like, man, you're like a real numbers guy when it comes to real estate. And so I do. That's why I get a kind of a kick out of it. I like it to say that.
I've got a range,
I like what you're referring to, just your Ferrari money. That's good. That's or Maserati or Lamborghini. That's great. But this has been some good information here, and I especially love the approach right now that you're taking in terms of that correction that is ahead when we don't know where it is or when it's going to happen, but we do know it will happen. So I think your approach there is excellent information that our listeners are going to really appreciate, and those that that have the guts and want to look at these other areas. I think it's great too. It's you got some good information and some talented people I know that you have connected with in that area. So I think there's going to be some good information.
Yeah.
Well, Buck, we kind of run to the end here, and you know the tradition here. We're at the end of the podcast.
You have to bark or something like.
You got to howl. You got to howl. Okay, and this is the sound that you'll make when that 100,000 you invested turned it into 1 billion. Okay, and cryptocurrencies here. So give us your best old crypto howl. Okay.
All right, I gotta be careful because the kids are outside the door and they may just freak out.
Okay.
I got a 9, 5, and 3-year-old, and they're gonna in here going, or they're gonna go tell my wife, "Daddy's howling."
Yeah, call 911. Okay, we'll accept that little lame howl there. It's great talking to you again. Thanks so much for coming on today.
Yeah, thanks for having me, Bill.
It's great. It's been a blast. And I also want to thank all our old dog listeners out there, too, for joining us. I know there's a lot of other things you could be doing right now, but the fact that you've taken the time to join us, it really means a lot, and we greatly appreciate it. Please note, everything we talked about here will be in our show notes on the Old Dogs website at olddogsreinetwork.com/blog. And look for the episode with Buck Joffrey. Well, that is the show for today. Remember, cash flow is king and real estate investing the means. Until next time, keep moving forward and may God bless.
Thank you very much for visiting the Old Dogs REI Network. We would greatly appreciate if you would stop by iTunes and let us know what you think of the show. We would love if you could subscribe to the podcast, give us a 5-star rating, and write a review. The more ratings and reviews we receive, the more visible the podcast will be to others. Thank you.